Hi there, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is if you had one chart, just one chart to review, to understand the overall market dynamics, besides just a regular chart of the S&P, what would it be and why? And what's funny is when I used to manage a team of professional analysts and when I required them to bring only one chart, it would be a hilarious competition as to who could get around that rule as easily as possible, or as cleverly as possible. So some would, pack as many indicators and techniques onto one chart as possible, so they could apply all their, get all their insights into one place. Some would do, put a bunch of different charts on one page and try to call that one chart. So by that inspiration, I've created a very busy yet informative one chart with 5 different data series that I think tell you everything you need to know about being risk on or risk off. So today is the chart for April 2021. All right, so we're going to get to my one chart for this week as an overall risk on versus risk off gauge. Before we get to that, I want to remind you, if this sort of thinking about market behavior, about investor decision-making routines, and charting and technical analysis is of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along the ride with us. Also, give the video a like if you could. I'd really appreciate it. Finally, put a comment below. Out of these techniques that I'm sharing with you today, which do you think is most important to watch going forward to understand risk on versus risk off? Let's get to the chart. All right, so as I mentioned in the introduction, I loved how I enjoyed very much watching my analysts when I manage a team of professional analysts, watching them try to skirt the rules in clever and more and more clever ways to try to, when I would limit them to one chart, just trying to get them to simplify, they would find ways to pile stuff into a chart. One technique is kind of what I'm showing you now, which is have one chart with a bunch of different data series. So you technically just have one chart, but you have a lot of different stuff on there. And this comes from a serious note. This comes from a reasonable investment approach, which is basically, if you want to understand, as far as I'm concerned, the main question you need to ask as an investor, the very first question, the most important one, is risk on or risk off. Should I be looking at stocks as an investment or not? And before you answer that question, you really don't have the right to look at sectors or styles or small cap or large cap, or certainly groups or individual stocks, because you haven't answered the first question: should I be buying stocks or not? So the very first question you need to answer as an investor is to say, is it a risk on or risk off environment? And I have a number of different ways that I try to do that. One of the ways I do it is with a market trend model that I've run for a number of years using weekly data on the S&P 500. Uses exponential moving averages as a read on the long-term, medium-term, short-term trends. But this is this chart actually combines a number of the different techniques that I use as risk on versus risk off measures. Every one of these lines that I'm going to share with you, someone who I trust and follow and whose work I've appreciated for years and years probably swears by that particular line. And that's so when I'm combining all of these on one chart, I'm sort of I hope acknowledging some of my mentors and investors that I've worked with that I think really know what they're doing. Having said that, let's break down the 5 inputs on this chart. Number 1 is the price of the S&P 500. Number 2 is the cumulative advanced decline line on the S&P 500. Number 3 is the equal weighted consumer discretionary versus consumer staples. 4th is small caps versus large caps. And then finally, S&P 500 new highs and new lows. Let's go through every one of these individually. I'll describe what they are and then tell you what they are saying about the current market environment and why overall the message is fairly constructive. Number 1, the price of the S&P 500. I always and have often been told, if you want to understand, if you have one chart to understand the S&P 500, it better be just a price of the S&P 500. Ralph Acampora swears by that. If you want to understand price, just look at price on its own and just understanding, is the market making new highs? Is the market making new lows? That alone should tell you a lot about the overall environment. So the fact that the S&P 500 on a closing basis continues to make new highs, when it pulls back, those lows tend to be higher than the previous lows. That is really all you need to know. That should be your one risk on or risk off chart, is looking at the S&P 500. And when you look at it on a closing basis, you can see pretty much consistently you've made higher highs. And then on the pullbacks, you've made higher lows, or at least you've not broken below there. On an intraday basis, it doesn't look as clean, but look on a closing basis. Here in June, here September, October, November, you sort of stayed steady, right? You keep making higher closing lows. So until that pattern breaks, until you make a new low using the closing prices of the S&P, overall the trend is up. So number one, thumbs up from the closing trend of the S&P 500. Number two is the cumulative advanced decline line. And basically what this is doing is at the end of every trading day, you can say how many stocks in a group in the S&P closed higher, how many closed lower, comparing today's close to the previous day. Every day you get an advancers decliners number, which basically tells you how many stocks closed up, how many stocks closed down. The cumulative advanced decline line takes that overall number. So every day you have a net number of advancers versus decliners, total advancers minus total decliners. And you keep adding those daily figures, and that comes up, that creates this line, which is a cumulative advanced decline line. This, along with the S&P 500, continues to make new highs. What often happens at a market top is you will have the S&P go higher, and the cumulative advanced decline line will actually start to slope lower. And what that indicates is that individual stocks are starting to rotate down, but the large mega cap, more defensive names are continuing to go higher, and that's enough that's enough strength from the largest stocks to keep the S&P, keep the index going higher. But the advanced decline line is an equal weighted measure. It looks at all of the 500 companies on an even footing. So if a lot of the stocks start to roll over, the advanced decline line will roll over, but the S&P will continue higher. That did not necessarily happen here in January and February of 2020. But if you look at the advanced decline line on the New York Stock Exchange, it did actually give you a negative turn. So at this point, it keeps making new highs, which is, again, confirming that the trend is up. So now you have two things pretty positive. The third one actually had been sideways for a little while and just actually made new highs again this week. This is the equal weighted consumer discretionary versus equal weighted consumer staples. Now, a lot of people, including me, look at the cap weighted version of this. You look at the XLY divided by the XLP. The XLY is the consumer discretionary ETF. The XLP is the consumer staples ETF. Now, that's not a bad thing. The problem is there are a couple of stocks within consumer discretionary that have an outsized weight because they're so big. They have such a large market cap that their movements alone will dramatically change the value of the XLY. Those stocks are Amazon, which is about 20-25% of the index on its own, Tesla, and Home Depot. Those three stocks are a huge, almost half of the XLY probably are those three stocks, or at least 40% or so, right? So the problem with that is you're really looking at those three stocks. You're looking at Amazon, Tesla, and Home Depot. This equal weighted version, if you look at this ratio, so it's actually, instead of using the XLY and the XLP, you use the RCD and the RHS. Those are equal weighted ETFs for those two sectors. You're looking more at a pure read on the average consumer discretionary stock, or really how that basket is doing versus the basket of consumer staple stocks. Not overweighting the largest stocks, but just looking at all of them together. What you can see here is that the cap weighted version actually has not broken out yet because some of those larger names are struggling, particularly Tesla off of its long-term highs, Amazon pulling back as well. But you can see the equal weighted version actually has made a new long-term high again this week. So what that's telling you is overall, if you take the entire consumer space as one big group and think of consumer discretionary as the more offense and consumer staples as the more defense, overall this trend is suggesting that within the consumer sector, investors are really going risk on, and they're staying with the more risk oriented consumer discretionary stocks. So overall, that is another thumbs up for the uptrend. Here's where things are less optimistic, and this is looking at small caps versus large caps, the ratio of the Russell 2000 using the IWM and the S&P 500 ETF, the SPY. Overall, you could see in general, in a bullish phase, small caps are going to outperform. That's not always been the case. And you certainly see, if you go back to like 2019, you can see the market was going higher, but the Russell 2000 was underperforming. This was during the FANG trade. That's what everyone was talking about, because those mega cap stocks were really outperforming. So small caps were underperforming, even though the market overall was doing well. So while this, again, each one of these on their own does not tell you the whole story, but combining them together sort of paints the overall mosaic. What you're seeing here is recently the S&P has gone to new highs, but you can see that the small cap stocks have been underperforming. The other kicker is small caps actually overweight financial stocks relative to the S&P 500, meaning there are many, the Russell 2000 index has a much bigger weighting in financials than the large cap index, the S&P, which has a bigger weight in things like technology and communication services. So when financials are doing well, the Russell 2000 is going to tend to outperform. So the Russell 2 outperformed, small caps outperformed here in the fourth quarter of last year into January, February, March, because financials are doing so well. In the last month, we've had the pullback in interest rates, and that's caused an underperformance in the financial sector and also has fueled an underperformance in small caps. Very interesting to see if interest rates are able to start hooking higher, which they potentially are doing this week, if this continues to go up along with the outperformance of the financial sector. So overall, it suggested weakness in small caps, which overall suggests sort of a risk-off mentality. However, it'll be interesting to see if that turns higher and indicates some of the leadership rotation continuing. By the way, if that did not make sense, what I just said about interest rates and what that means, I recorded another video on my YouTube channel last week, I want to say, focusing on interest rates and what that means for different sectors and leadership rotation. So check that out if you missed it. Finally, the last of the 5 inputs is the S&P 500 new highs and new lows. This is looking at the number of stocks every day that are making a new 52-week high and the number that are making a new 52-week low. New highs are in green. New lows, you see essentially 0 for the longest time. If you look back here to the March 2020 sell-off, you'll see what happens when the market sells off, when you have a number of stocks making new 52-week lows. We've had very few in recent history, essentially 0 in the last couple months, to be honest with you, going back to late October of last year. And overall, a healthy uptrend has an expansion in new highs. You're going to have more and more stocks making new 52-week highs, as stocks are not just in uptrends, but breaking new ground, pushing the index higher. So if the index is going higher, you want to see a healthy number of S&P stocks making new highs as well. So overall, if you look here, recently when we had a big up day, this was, I think this is last Friday, maybe what we're looking at here. But basically when you had a big up day in stocks, about 20% of the S&P was making a new 52-week high. That's a pretty decent number. That's a healthy number within an uptrend. So overall, you have the S&P price going higher. That's one positive. You have the advanced decline line making new highs. That's positive too. You have the equal weighted consumer discretionary over consumer staples making a new high. That's a thumbs up. Small caps underperforming, not a thumbs up. That's sort of a negative. And then finally, you have S&P new highs expanding pretty nicely. Overall, a healthy amount. So 4 out of these 5 are really indicating a strong market environment. The one that is not is less horribly negative. We're telling you about leadership rotation and talking about how some of the mega cap stocks like Microsoft, Alphabet have been making new highs. That's what's helping to push the S&P higher. Those big growthy names and not as much the value stocks that are represented a little more in the Russell 2000 index. So overall, here's the conclusion. The trend is positive. We know that from the fact that the S&P is going higher, but these other indications sort of qualify and validate the fact that overall it's a healthy market environment. The reason why this is my one chart right now is at some point this is going to change. At some point, the S&P makes a lower high. At some point, the S&P makes a lower low. That would be the negative signal there. At some point, the S&P advanced decline line either does not confirm new highs. So the S&P goes higher, but the advanced decline line starts to slope downwards. That would be an area of concern. Or we make a new swing low at the advanced decline line. That would be a negative. You would want to see, if you're looking more cautiously, you would need to see the ratio of consumer discretionary versus staples breaking down to a new swing low would indicate that institutional investors, larger investors, are rotating more to the defensive side of the consumer space. You'd expect to see small caps continue to underperform. That would be another headwind to outperformance. And finally, a drying up or a lessening of new highs. Instead of new highs expanding, you'd see new highs contracting. At some point, you might see a random number of new lows, which tells you stocks are actually selling off to the point that they're making a new 52-week low. So overall, this chart right now is supporting the fact that the S&P has been in an uptrend. It tells you overall the conditions are fine. It tells you it's a healthy environment to be looking for long opportunities if that's something you're interested in. But this is the chart that I would look for to see when those conditions change. At some point, especially now that we're entering the seasonally weakest part of the year, starting in May, going through October, this would be the chart that I will watch to see when the conditions are starting to look less bullish and a little more bearish. So that is what I call the chart. I always, again, when I've asked people to bring one chart with them, I often enjoy when people cram a number of different inputs into one chart. Instead of giving me one thing, they're giving me like 5 things on one chart. That's what I provided for you today, sort of the chart, right? The chart that combines a bunch of different inputs. If you follow this and look for when the conditions change from overall very bullish to overall very net bearish, I think you will have a good sense of when the market starts to rotate lower. As of today, it's not really happening. Again, if this sort of thinking about market dynamics, market psychology, investor sentiment, behavior, and charting is of interest to you, I hope you'll subscribe. I'd love to have you along this ride with me on the Market Misbehavior channel. Also, give the video a like if you could. We certainly very much appreciate it and value that. Finally, put a comment below the video. Tell me, out of these 5 inputs that I just shared with you, which to you is the most important to understand the overall market direction? From everyone here at Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you soon.